All right.
What's up, guys? Roger and Norv back again. So we're going to bring you guys some data today, some data from Redfin, possible recession coming up. We're going to look at a couple of charts. And basically the concept of this video here is we think there's going to be a 6-month, possibly more or less, give or take. There's going to be a nice window if you're looking to buy a home to get a really, really good deal, because we're in a frenzy, which we believe is possibly going to slow down. And then after this 6-month period, we're going to have another frenzy. So let's just get right into it. It'll all tie together. Okay, so watch the video in its entirety, because all of the points we're going to make, all these puzzle pieces are coming together and it's going to be clear. All right.
What's happening, everyone? Well said, Roger.
Norv, what's going on? How are you doing today?
Doing good. Doing good. Thanks, man. Excited about these topics. I think we're onto something here, and it's exactly what we'd like to share with our watchers and viewers, and just to make sure that we're all on the same page and we can take advantage and make the most out of this time period.
Yes, absolutely. Okay, so I'm going to start in with the Redfin data. Today's April 4th, 2022. I'm going to share my screen here. So if you guys have been watching our videos, a couple of videos ago, we talked about possible slowdown in the market, right? So that's what we called. Some people said bullshit, it's not happening, whatever. So and then yesterday we saw this article come out from Redfin. So housing market update: surging mortgage rates and home prices sideline more buyers. The market still feels hot, but a slowdown in online searches, home tours, and mortgage applications suggest more buyers are getting priced out. Redfin economists predict home price growth will start to slow in the coming months. So we talked about this literally a week ago. Redfin comes out with this article. I think we have a decent heartbeat, like feel of the real estate market. And then Norv has a ton of knowledge in stocks and bonds. And those two combined, I think, kind of help put us in a position where we kind of saw this coming.
Definitely.
So, okay, so just moving on real quickly, we're just going to cover this article a little bit. Mortgage rates are shooting up at the fastest pace in history, sending the typical monthly mortgage payment for a home buyer up $500 since the beginning of this year. And then when they say it's gone up $500 for the average buyer, they're talking median home price. So these are people who are buying this is across the country. You're talking about someone buying a $400,000 house, someone who makes maybe 50, 60, 70 grand a year. Their payment's going up $500 a month. And Norv did a breakdown of this a couple of videos ago of how much these rates have caused payments to go up. And it's going to sideline some people because A, they just don't qualify anymore, right? You can only have a certain amount of debt, and this increase, you're out. You just can't get a mortgage. And number two, some people are just not as comfortable, right? Like they had a little bit of leeway, like, all right, well, I can afford this mortgage payment. That's what I'm comfortable with. But now with this increase, I'm not comfortable anymore. So if we go down a little bit more, the market still feels very hot, with homes selling faster than before. That's still because of record low in inventory. So again, we know the record low inventory is still causing things to be hot. Redfin chief economist Daryl Fairweather says we're hoping the market slows down from 100 miles an hour to 90 or 75. So again, that's kind of what we're predicting, right? That's what we think is going to happen, right? We're thinking the market's going to slow down a little bit. Again, it's going to be competitive, but again, what we're hoping for is we're going to go from 20 offers on a house to maybe 10 or 5 and give you guys a better opportunity to get your offer accepted. Okay. So what else can we see here? Okay, so another real estate agent, Aaron McCarthy, in the Bay Area. Bidding wars are still common, but homes that would have brought in 10 or more offers are getting half as many. Homes aren't selling as astronomically over asking as before, where they would sell for 700 over asking 2 months ago. Now they're maybe going 300-400 over today, which again is still pretty crazy, but slowing down. Okay, one more thing before we move on. The rise in mortgage rates is on the top of sellers' minds too. Justin Hess, a Denver Redfin realtor, who focuses on listings, said, if you've been considering putting your home on the market, now's the time. There's still plenty of buyers, and mortgage rates are only going to keep climbing, making it more expensive to find your next home. So again, if you're a seller and you're going to move somewhere else, you got to be thinking for yourself too. But the next home I'm going to buy is going to have a high rate because rates are going up. So I got to make this move faster. So hopefully there's more homes coming on the market. So Redfin data, you know, they do home, they're realtors. You know, Redfin is a real estate company. So they do showings. They get some data from showing time and online searches. Google online searches for homes for sale has dropped 10%. In addition to this Redfin data. So it's slowing down. We're not saying we're in a buyer's market, okay? Just to be clear, we're not saying we're in a buyer's market, but we're slowly shifting where it's a little bit more even. So that's the first piece of the puzzle. Okay, so Norv, take us into the second piece of the puzzle and how it's all gonna come together with recession, bonds, and so on.
Yes, sir. So a lot of great points there, and I just, I think those are all kind of natural occurrences, right? Where these things are happening. There's a psyche shift happening, so sellers could be thinking maybe this is the best time for me to make that move to avoid from rates going higher, so I can get a better rate. And then they think maybe at this point, well, they've already kind of maximized their time in trying to get top dollar for their property at this point. Because why would you want to sell last year, right? And so you're more inclined to do it this year when there is this this thing happening with rates, and so on the notion that I might not get as high of an offer as I will maybe a couple months from now. So let me do it now. So that could put some more homes on the market. What the Fed's doing, I think, is trying to fight inflation. Inflation's out of control, and so with that being said, it's definitely having somewhat of an impact. There are those other indicators out there that show this sort of on the horizon if things sort of go at this pace, and inflation is just this much of a headwind, and the Fed steps in front of it every single meeting this year with the possibility of 8 rate hikes on the table, right? So all of that is, the market's digesting all that, and from what we're seeing and what we are hearing on this is that based on everything else we've seen in the past, is that this swing on the pendulum, right, is all the way to the right now, and inflation is skyrocketing, and the Fed's trying to put a stop to that. And so the one thing that we want to point out here today is that pendulum swing could be coming naturally back over to the left. And so what that's going to happen, and to tie all this in together with inflation, is sort of the natural occurrence in that, and it's the Fed raises Fed funds rate, but that doesn't mean that mortgage rates will continue to shoot up. So this is going to put us on the brink of a recession, and those indicators that point this out show that it could be happening in the next 3 to 6 months. As we have economic activity slow down, we'll see if we do hit that key sort of point where we start to see all of these active indicators start to show a slowdown in economic activity, the market will, translate that, right, by selling off. And so we'll see the market kind of come in, stocks and equities selling off because things are slowing down, because these companies are now pricing in heavy growth that's just not there anymore. So P&E multiples start to get adjusted, the market starts selling off, and you'll see a natural flow back into bonds. And what that will do is bring mortgage rates back down naturally, right? So it doesn't. So with the Fed sort of where they are now, they want to put us in that position. They want a recession. They want to slow things down because it's just out of control. And so they've said in front of Congress, right? And they'll do everything they can to put us on the brink of a recession. And it's a good thing. Recessions are normal economic cycles. They're natural occurrences, and they need to happen. They're good for the economy, and good for the overall long-term health of the economy. So these things have to happen, and it's going to happen based on what we've seen in the last couple of years and where we are today. That slowdown and that rate increase. So how does this all tie in? I think with where we are today, and the point we want to make with our clients today is that as there is this slowdown, possible slight slowdown, right? Instead of 20 offers, 10 offers on a property, I think the focus still should be, if you're in the market, to not have fear, still look for a good deal on a property. Take that rate, whether we talk to you and you decide to do an adjustable to keep your payment low today and not pay that premium, or you decide to play it safe and put yourself in a 30-year just to be safe. Because one thing I think we can all sort of agree on is rates will go higher from here before they go lower. Even though, you know, we're currently at about a 4.875 to 5%. On a 30-year fixed conventional high balance with perfect credit, right? So you think that and sort of you know, work with the time frame that we have, about 3 to 6 months. You know, it's safe to assume that we'll probably be in the higher fives until we get to that point where the market starts to realize that we're maybe on the brink of a recession. So then we'll see maybe rates as the economy slows down and the indicators start to come out, that shift in bonds from equities into bonds, and then rates coming back down into the fours, you know, probably. So the point, long story short, is that, you know, you get a good deal on a property with rates where they are today. It gives you a good opportunity to get in the market. I have a lot of buyers out there that are frustrated, man. Offer after offer, 20, 30 other offers on the same property. So I think it's going to be great for a lot of the buyers out there, and you know, to have less competition, be able to get yourself in a property, get a good deal, have a good agent, get a good deal, maybe even negotiate a little bit. Gives you the opportunity. The economy, the situation right now gives you a little bit of a better opportunity as a buyer than a few months ago, for sure. So when that happens, then we can sort of have all of this in mind, we can game plan and know that we have a pretty good chance 6 months to a year from now to put you in a better rate.
So that was a lot to unpack.
Yeah.
That was a lot of information. I'm going to try to break it down very simply in like a couple sentences. So inflation's out of control. The Fed raises rates to slow down inflation. Okay, so mortgage rates go up. The rates on everything goes up. So when they raise rates, the Fed is controlling or slowing down the economy. When the Fed raises rates, slows down the economy, we go into a recession. When we go into a recession, the stock market goes down. So if you're an investor and the stock market is going down, you're going to sell, and then you're going to put your money that you sold from stocks, you put it into bonds. And then naturally, by an investor moving his money from stocks to bonds, is going to result in rates coming back down.
That's right.
Right? Is that right?
That's right.
So
that's the entire notion.
Yeah.
Yep.
So basically, from the time they're already raising rates, right? The economy is going to slow down. We're going to look at a chart real quick that shows that, hey, we're on the brink of a recession. Everyone's been talking about it, which again, like Norv said, it's normal, healthy for an economy to have a recession, to flush out the bad cards. So as we go into this recession in the next few months, possibly, rates can come back down. And we already saw based on the past 2 years, when rates are low, the housing market is out of control. So that's the period we're talking about. So as we're in the recession, that might be the best time to buy the house at a higher rate, mortgage rate, because we're expecting rates to come back down and you can refinance.
Exactly.
Cool. Okay. All right. So real quick, let's jump into this this chart here. Okay. So again, we try to make things as simple, not complicated as possible. So what controls mortgage rates is bonds, right? So bonds are at what is it called, Norv? What is it right now? An inversion?
Inversion of the yield, yeah.
Inversion of the yield. Okay, so the 10-year is basically one of the charts, the bond charts, did an inverted yield curve, and basically we got this information from Barry Habib and his team. Okay, so this curve that happened has happened 5 times in the past. These are the dates that this has happened. So it doesn't happen very often, but when it does, it's an indicator that we're going into a recession. So this here on the right, every time this curve happens, again, not to confuse you guys or to go into it too much, when this indicator happens, we go into a recession. You could see one time in 1998, it took 868 days to go into a recession, kind of an anomaly. But if we include that, on average, we go into a recession in 10 months. So that inflection point, whatever happened, is happening right now. So on average, it takes 10 months to go into a recession. If we take out this 1998 factor, which was 800 days, the average time that it took for the economy to go into a recession was about 162 days, which is 5 to 6 months. As you could see, as the years go by, the number of days shortens because we're in such an advanced technological time right now. Everything happens faster, right? So we go into a recession faster. So we could be going into recession in 3 to 6 months. And again, like we just said, when that happens, the money will flow from stocks to bonds, causing rates to come back down. So Norv, what else would you add, or what would you be telling buyers? You kind of touched on it a little bit, but what would you be telling a buyer right now who's watching this video?
I think it's the opportunity I think we've all been waiting for. Just from all the conversations I have with my clients and knowing everything they've dealt with in the last couple of years, and there are a lot of buyers that just haven't been able to buy. They've put multiple offers on multiple different properties, and it's just been frustrating as hell, and it's been pure torture for some, and because they're desperate. And so what I would tell them is this is what we've been waiting for, and this is really healthy, and this is what the market needs. And so the Fed coming in here and fighting inflation, obviously the bigger picture, there's a lot going on, and so this, if this continued to can you imagine if we had 2% rates or low 3 rates still?
Oh man, the housing market would be out of control.
The market be like?
It would be out of control. It'd be out of control.
So I think that would have priced out a lot more people than this does by slowing it down now. So with higher rates, we stabilize the market. We need stability because it it got worse every single month, just that much more. And I think that would have, the end result in that, had we still had 3% rates, would have just been catastrophic. It would have put us in a bubble, and so many more people would have been out of the picture. As it is, I think all the loan limits were raised to much more than ever before, right? We went up $150,000 on the high balance from 822 to 970. Our high balance used to, in just 1 year. And so that, I think, even then, a lot of these homes that we service in these areas and the mortgages that we do, we're already seeing that the high balance 970 wasn't even cutting it. We're already in the jumbo territory. So I think that was a big headwind. And so what I would tell them, in short, is this is the perfect opportunity. I think if you're a first-time home buyer and you're out there in the market, I think you're, sort of should be licking your chops at the possibility of, that home that you're interested in having less offers than it would have last year, or if rates were still in 3% in the threes now. So this gives you an opportunity. And then with everything else, I think I would talk to them about all the other points. Is that these things happen, they're natural occurrences. You don't have to stay in this mortgage for 30 years. There is no prepayment penalty, but let's strategize. Get a good agent, put a solid offer in place. You may not have to go a whole lot over asking, right, these days. So be strategic in what you do in the offer, and how you approach the offer. You may still have to not have a loan contingency and an appraisal contingency nor an inspection contingency. So that might still have to be the way these offers are submitted, but you have a much better shot at being on the top end of those offers. And then if you can get yourself approved these days with rates where they are, then it's as good as it's ever been in the last couple of years. Get yourself in the home, and then get out and refi 6 months to a year from now. But we'll see rates go up before they come down. So this is a good window before the Fed hikes anymore, and before we see sort of the market sort of price that in, and until we get to that recession point you pointed out with the dates sort of that were to expect that to happen in. And then when that does, you'll refi lower and drop the payment a whole lot. So yeah.
This is the golden window. You heard it here. There's gonna be a window here because, I mean, anyone who's tried to buy a house, anyone who has been, obviously you're watching this video, so you're interested in real estate. You've been probably interested in real estate for the past 2 years. You've seen how much prices have gone up. Just imagine fast forwarding a year and rates are back in the 3% range. What a frenzy it's going to be again. So before that happens, and right now, while there's fear in the market, take advantage and land a property, because as we talked about in our last video, every single time the Fed raises rates to control inflation, every time it's happened, from Paul Volcker to Alan Greenspan, do your research. Every time that happens, rates come back down after inflation is taken care of. After the inflation problem is fixed, rates always come back down. So you'll have a chance to refinance. Hopefully, nothing's guaranteed, but looks like history will repeat itself. So you want to do your research, be knowledgeable. And any final thoughts, Nor, before we sign off?
I think that's pretty much it. I think rates are still historically low. So even with where they are, all of this sort of, you look historically, we're still in a very, average, lower on the lower end of the, rate environment. So I think it's a good time, great time. So that's pretty much it. And for maybe if you're that one borrower that has seen, but the point I want to make is we've seen a lot of activity in the non-QM side too on mortgages that are the non-traditional mortgages, right? And so that's also an indicator that maybe there are a lot of different approaches. And I think so if you're that borrower that maybe on paper are not qualifying, give us a call. We have other options. We have non-traditional mortgages, and we can qualify you, especially if you're self-employed. I think this is, you have a lot more options than someone that's, employed through a W-2 and their income is limited. Whereas if you're self-employed, we could have other incomes, other structures of income calculations taken into account and get you to qualify. And so you can take advantage.
So if you want to learn more about non-QM loans, leave a comment and ask us what is a non-QM loan. I'd love to hear more about it. And if if we see enough comments, we can make a video on it. And follow Norv on Instagram at Norv Home Loans. I'm on Instagram, Roger Mortgage Expert. Subscribe to our channel. We're going to be making shows, at least 1 or 2 a week. Like we have been updating you guys on the real estate market. We just want to share with you guys because we're on the front lines. Norv and I are both loan originators, loan officers, real estate agents. So we're dealing with people and are on the front line. So we're just bringing you our knowledge. So subscribe. And what else? Oh, I'm having surgery on Wednesday, a little hernia surgery, nothing too crazy, but I should be back, should be making shows. Hopefully Thursday and Friday, we'll have another update. And yeah, just like and subscribe.
Yes, sir. Sounds great. Definitely. Reach out to us and then we can have further conversations or do another video and like you said, talk about non-QM stuff, but hope your surgery goes well, man.
Thank you.
We'll hopefully maybe be able to do one if you're feeling well towards the end of the week to recap this.
Yeah, for sure. All right, guys, take care. We'll see you next time.
Thank you, everyone. All right.
Bye.
Bye-bye.